Well, it was another erratic day on Wall Street. We've had a few of those sessions here recently, but at least this time it was a positive one for the bulls. Today was the revenge of the bulls. The S&P 500 ended up closing up 1.74%, which all by itself, of course, is a monstrous day to the upside. However, when taken in context with what's happened in the last week or so, we still got a lot of work to do to get back to just where we were last week. So what does today's price movement mean in terms of posture using the market forecast indicator? We're going to break that down and, of course, practice our philosophy with a trade application idea as well. So let's go ahead and get started. Welcome to the Market Outlook video. I'm your host, Brandon Van Zee, and it's February 6th, 2018. Great to have every one of you on board, whether this is your first time or whether you're a long-time listener. David and I certainly appreciate your viewership here. Remember, if you're getting value out of these videos, we would encourage you to subscribe to our YouTube channel. Click that bell icon as well to be notified whenever we upload these to YouTube. If you really enjoy them, make sure you're clicking the thumbs up to let us know as well. That's our barometer to let us know whether we should be continuing these videos in the future or not. Obviously, we don't want to waste your guys' time, and we've got plenty of things to do with our own time. So we want to make sure this is a valuable experience for both parties there. So we certainly appreciate your likes there. Also, if you go and scroll down to the bottom, you can find some comments area. So if you do have comments about what we're talking about in these videos, we'd love to hear from you there. And then lastly, in the description area in the YouTube, you can also find that we have a link to sign up for our daily kind of distribution email that many of you receive. And that will allow you to see all the different clusters that are occurring on a day-to-day basis as well. Now, in addition to YouTube, we're also heavy users of Twitter. In fact, I would have to say that of all the different social media outlets out there, Twitter is the place where David and I will take to the most to share our thoughts. We had some excellent commentary today with some of you regarding some of those VIX ETFs on my Twitter account today, so I appreciate the back and forth there for sure. But remember, if you enjoy these nightly videos, be sure to like them on Twitter and retweet them, so that way those in your social network will also get the benefit of seeing some of these videos. And it also helps Twitter know that you appreciate seeing this type of content from David and myself, and Twitter will then send you this type of notifications a lot faster than they would otherwise as well. Now, in addition to Twitter, we're on Facebook as well, and we'd invite you to join our group there. We now have over 800 of you that have joined, and it's a great place to kind of have some back and forth as well. All right, so let's go ahead and take a look at the markets now. So let's take a peek at the S&P 500. As you can see, I've got the chart pulled up in front of us here, and we have this nice, healthy looking bullish candle here today, which, as I mentioned in the intro, was up 1.74%. However, the background color of the chart remains pink, and as a reminder, that occurs whenever we have that green intermediate line, which is what we judge our posture by on these market forecast video, our market outlook videos, where we're using the market forecast tool. So remember that despite today's big move up, we would still be determined to have a bearish posture. In fact, you might even say it's a strongly bearish posture, because you'll notice that if you read the label here on my green label, it says the intermediate term line is at 47.40 and falling. A lot of times we do make a distinction. When it falls below 50, it is a more aggressive bearish signal there. So we just want to be cognizant of that. Obviously, there's been a lot of turmoil in the last couple of weeks, and we don't want to panic. You know, that's one thing that we've got to be aware of as well. Sometimes we get wrapped up in the emotion of the situation and we make the wrong decision at the wrong time. You know, everybody who panicked and just sold out of their entire portfolio yesterday might be regretting that today as the market is now up. And of course, just like what the market is up right now doesn't mean that you should be going all in right now, because we could very well see more of these back and forth choppy types of trading sessions here in the future. We've kind of been lulled to sleep in a way. And, you know, I've had a lot of people in the last 48 hours or so ask me, hey, how you holding up there? And surprisingly, I didn't feel too bad about things yesterday. I probably should have, don't get me wrong. But it's just interesting because I can almost tell you definitely that my portfolio took the biggest hit it's ever taken yesterday. All right, so I'm not here saying that I didn't get hurt yesterday. Like a lot of you guys, my portfolio dropped significantly yesterday. Now, on an absolute dollars basis, I would have to believe yesterday was the worst day I've ever experienced as an investor. Not on a percentage basis, but that's yet another part of this story, is that as we go on, especially somebody that's the working age like myself, your portfolios tend to get bigger and bigger and bigger because you're constantly adding to your retirement account. And so these types of pullbacks that we've experienced can make a pretty big dent. And if we're not learning important lessons along the way, and if we're ignoring lessons that we should be learning, it makes it a lot worse of a scenario, because when you make mistakes in the future, your portfolio balance is probably going to be a lot bigger than it is right now if you're not learning from your mistakes right now. So it's an important discussion to keep on learning whenever you can. And I'm just as guilty of it as anybody. I can certainly improve my own behavior, my own trading, my own style. If we keep on working on it, I think it'll be beneficial down the road. At least that's the hope. So you might ask then, well, why weren't you feeling worse about things yesterday? I think the reason comes down to, and each person has to ask themselves that individually, but for me, I've looked at the gains that we've had in the last several months as almost fictitious. In fact, some of you that follow me on Twitter know that, a couple weeks ago, I put together a little image where I had this book, and I said it was a New York Times bestseller, and it was a fairy tale. And that's kind of how I felt about this market. It felt like we were living in a fairy tale. Was I happy to be participating in that fairy tale? Of course. Who doesn't like bigger and bigger gains when you're looking at your portfolio every day? But it didn't ever feel real. And so when a day like yesterday comes out of the blue and just smacks you across the face, you kind of take it in perspective and just kind of remember where you've come from. Now, I don't want to belittle it either, because I'm sure there are some of you that are watching this video right now that maybe you just got invested in the markets in the last couple of months. And if that's the case, that's going to hurt. Now, keep in mind, I myself got invested in the markets right at the end of 1999, at the beginning of 2000. That was in the heart of the dot-com bubble. And I was buying tech stocks back then. So believe me, when it comes to making every mistake in the book, I have. So if you are one of those people that bought stocks here in the last couple of months, don't beat yourself up too bad. Times will get better. There's no denying that. Markets do go from the lower left to the upper right over the long term. But on the other hand, bear markets are a rule. They're not an exception. Bear markets will always happen. And it's been, 9 years since we've had one? Is this the start of our next one? Remember, a bear market is down 20% from the high. A correction is down 10% from the high. We haven't even had a correction yet. We finally hit 5% from the high within the most recent market swoon. So if you are one of those people that just bought stocks within the last couple of months, your very first investments ever, learn from this. This is an opportunity. You're likely younger if you're just buying stocks now, and you got a whole world in front of you. For the rest of you, myself included, hopefully you've been very bullish this market for a very long time, right? Hopefully you haven't been sitting on the sidelines for the last several years. So again, keep things in perspective. If I look at the S&P 500 right here, and let's just go back on, let's say, just a 1-year chart. Remember, in the grand scheme of things, 1 year is just a blip on the screen in your career as an investor. But even so, we're still up 16% over the last year. Year over year, we're still up 16%, despite what some people would feel like is a panic, everybody head for the sidelines type of a situation that we had. Where we stand right now basically brings us back to this candle right here at the beginning of January. That's all that's happened. So let's just try to be calm, and that's hard to do. I get it. But, this is a moment where the market seemed to be hyperventilating to some degree. But let's try to take things in stride. Let's keep a level head about what we're doing. Let's look for opportunities when they may be presenting themselves as well, especially for those of you that are longer term investors. Now, this particular product that we do here, this market outlook video, is a little bit more geared toward the trader. I get that. But I know a lot of you that follow me, especially with the dividend growth investing style that I have, there are opportunities out there. Now, surprisingly, there haven't been a lot. That was one of the other surprises that I had yesterday. A lot of times when we have those dislocation types of days like we saw yesterday, I've got all kinds of buy orders going off left and right. When we had that mini flash crash in August of 2015, that was the case. Yesterday, it wasn't that way. I did get one trade filled, but I was somewhat surprised that I didn't get more. And that also tells me that despite the major pullback that we've had, this market still is not at a level where I would consider it just a flat out value. Maybe there are others that would disagree with me, and that's fine. There's a lot of room for healthy disagreement in this business. But it is a reminder that what has happened so far isn't necessarily the bottom either. It's just a reminder that this is the reality of the market. This is your entrance price to get in to the money-making machine that is the stock market over the long haul. Some of you got your first taste of that here in the last 48 hours or so, and there's valuable lessons to be learned across the board. In fact, one of the other lessons, I'll continue my soapbox speech here a little bit if you'll allow me. One of the things I've been talking about on Twitter here in the last 2 days has been this SVXY. Here was one of the charts that I talked about it here earlier today, and was also talking about it yesterday when I just happened to glance at CNBC and noticed that there's this product that's down $83 per share, trading at $22 after hours. That's SVXY. Now we've come to learn that it's a lot of these VIX-oriented products that have been getting the fingers pointed at them for causing some of these market disruptions we've seen here over the last week. SVXY is not alone. There were a couple of them. In fact, let me pull up our charts here again briefly. And here's SVXY. Now again, to put this into context, I need to go back over a year for this particular chart. So let's go back on a 5-year chart. Look at what has just happened. This particular product lost 82% today. And you're now trading at a low of 11.11 today. It closed at 12.24. But the point is, you are now at levels lower than any time in 5 years. Imagine being the person that would have been buying this at any point on the way up and watching their gains evaporate. I posted a story on Twitter of a guy who lost $4 million. Might not have been on this one. It might have been on XIV, which is very similar to it. And you can see XIV just as bad. In fact, XIV was down 93% in one session here today. It closed at $7. It lost $108 per share today. It's insane to think about. And it reminds you how quickly things can spiral out of control if you're in the wrong products. Now, I got to be careful here because I never want to tell you what you should or should not do. It's funny because at my previous employer, many of you guys attended my online coaching classes, and you'll know that I personally was disgusted by a lot of these leveraged ETFs to the point where I would flat out say, stay away from them. Now, I got talked to a couple of times from a compliance perspective saying, hey, we don't give advice. And that's true. I don't blame compliance for talking to me about that perspective. But they were saying, even when you caution somebody away from these types of products, that's somewhat like giving advice. You're telling them not to do something. I'm like, well, I kind of disagree with you there, but that's the job, I suppose. So at my own, difficulties there, I kind of struggled, but I continue to do it, saying, stay away from these leveraged products. Now, people could have been, telling me for months and months and months, Brandon, you're wrong. These leveraged products are the greatest thing since sliced bread. Well, in one day, you are wiped out. So some of you who have been around long enough, hopefully you've stayed a long, long ways away from these types of products. Now, and another thing I should tell you, I'm not perfect. The reason I'm so adamant about these particular leverage products is because I got burned by them a long time ago as well. Now, thankfully, it was before 2011. It was somewhere between 2009, 2011. I don't remember when exactly, but I got burned by them. So I learned my lesson. I said never again. And so that's why I've always been so adamant about these things. Now, some of you, again, are going to disagree, and that's fine. If you are going to trade these types of products, make sure you're closing out your positions by the end of the day. It's all there is to it. You can't hold these for the long term because you never know when something like this is going to snap and it's just going to break. Now, when it comes to stocks that go down in value, I get that. Stocks are risky inherently. That's just the way that it works. But at least you give yourself a fighting chance. Let's say that you've been in Kimberly-Clark as just a random example. Well, like a lot of stocks, Kimberly-Clark is down fairly significantly. It touched a high of $138. It's now at $114. That's not fun to live through by any means, but the chances of Kimberly-Clark still selling boxes of Kleenex 10 years from now, in my opinion, is fairly strong, and at least you're giving yourself a fighting chance to have a profitable investment over time with your dividends reinvested, so on and so forth. Again, that's not a recommendation for Kimberly-Clark. I'm just making an example here. On the other hand, I'm also highly convinced that 10 years from right now, XIV will not exist. Either will SVXY and many of the other leveraged ETFs. They just will go to dust. Now, the unfortunate part is that some of them have been allowed to stick around longer than they probably should have. And what you're finding is that you've got reverse split after reverse split after reverse split. I think I had an example of that here that I also posted to Twitter, but I'll show it here as well. This is UVXY. This is the ultra short VIX short-term futures. Now, notice what's going on here. It's a little bit easier to see these on profit charts, which is why I'm using that for this example here, because they've got these little icons that'll represent splits that have happened along the way. Well, look at all of them. We've got a 1-for-4 split. Now, remember, a lot of times you guys are thinking splits are a good thing, right? Well, sometimes. The right kinds of splits are good. This is a reverse split. This is the opposite. This means when a stock gets close to zero, or in this case, an ETF or an exchange-traded product of some sort gets close to zero, they magically make the share price bigger. And they do reverse splits. So here's a 1-for-4 reverse split. Here's a 1-for-5 reverse split. Here's a 1-for-5 reverse split. Here's another 1-for-5 reverse split. Here's a 1-for-4 reverse split. Here's a 1-for-10 reverse split. And here's another 1-for-10 reverse split way back in 2012. So when you go back and adjust the share prices, this is no joke. This is a nearly $10,000 instrument that today is worth $15. Now, yesterday it was up 66%, and people would think, oh, okay, this looks like a great way to hedge my portfolio. And you got all these new suckers coming into these particular products, and they're going to get their head handed to them at some point as well. Now, if you're sophisticated enough to manage your risk, et cetera, go right ahead. Be my guest. I'm not telling you what to do or what not to do. I'm just merely saying I don't like to see people get hurt. And I really wish the SEC would just shut these darn things down, because too many innocent people do get hurt with these and they don't know any better. But hopefully, if you guys have been around the block a time or two, you do know better. I know one thing is for certain. If you've been to my online coaching classes in the past, you do know my feelings on these particular products. And that's another thing that I will point out is that when David and I get rolling again here with Market Scholars in the future, we will have an online coaching type of format of class. It's not going to be called that probably, but it will be a question and answer session. Because remember, some of these types of topics, they're not going to get brought up in the course of a normal trading room because they have nothing to do with whatever strategy it is that you're implementing. But I think there's a lot of value to this back and forth between student and coach. What are your thoughts about X, Y, or Z, right? And so we're looking forward to getting that kicked back into gear as well, because I understand that at our former employer, that particular product might not exist anymore. So I know a lot of you are longing for that sort of thing, and I think it does highlight the advantage that they come with as well when we have discussions like this. So if you were someone that got stung by these things, try to pick the pieces up. I know it might be tough. You might be suffering total losses with these positions that you're looking at here, these leveraged products. But we need to learn from our mistakes. We need to pick ourselves up. We have to remember what the essence of the stock market was to begin with when it was started hundreds of years ago, and it was a place for people with money to invest in actual operating businesses that are out there. This idea of investing in these highly leveraged derivative products didn't exist 200 years ago. So kind of get back to the grassroots if you feel like you're somebody that's been burned by this. Some of you enjoy that sort of thing, and I'll let you have it. It's not my cup of tea, but at any rate, hopefully you can survive and learn from these mistakes that have been taking place here in recent sessions by a lot of traders. Feel bad for the amount of money that some of them have lost, that's for certain. Let's get back on track with a few more charts here in our analysis. Let's take a look here at our next chart, which is a foregrid that will show us what's going on with the various indices here in the United States. Now notice that all 4 of these charts are colored pink backgrounds, which tells us that according to the intermediate term posture using the market forecast indicator, they're all bearish across the board. So it doesn't matter if it's the S&P 500, the Dow Jones, NASDAQ, Russell 2000. Remember, the Russell 2000 was the one that gave us the heads up a week or so ago. It turned pink before the other ones did. So remember, sometimes the small cap market can be manipulated up and down more because big money pushed into those or out of them can kind of give you some cues. So that's another thing to think about in the future. If you ever start seeing the Russell taking a big move and the other ones are not yet, maybe just put a pin in that and see if there's something else behind that particular move. If we take a look at our next chart, let's see here. This one's going to be our 3 green arrows / 3 red arrows chart, where we're using the 30-day moving average along with the stochastics and the MACD to see, what the markets are telling us. And again, same thing here. Across the board, bearishness. No surprise there. We've had one of the most historically volatile weeks ever in the last 5 days. And of course, whenever things get really volatile, it's usually to the detriment of prices in the equity market. And so bearish conditions across the board, which means if you're using stop losses based off of some of the methods you've learned in the past, make sure you're following those. Some of you guys have seen the stop losses that I've been moving up with our trend trading account on Twitter as I'm putting that information out there. So if you're not following me on Twitter, here's another reminder, do so. My handle is @BrandonVanZ, all one word. All right, moving right along here to our longer term charts. This is where things are going to get somewhat interesting. Last week I probably tempted fate when I said, in the next couple of months, we could have prices go down to that black line, but you're probably not going to find that the orange line is going to cross the black line. Somewhat humorous. We got to try to keep it light, try to keep a positive perspective on what we're doing as investors. But it is somewhat humorous that I just mentioned that, because in the case of the Russell 2000, at least, we actually did come down and touch that black line. Now, we didn't close below it, but price did touch that black line, which, as a reminder, that's your 40-period moving average, and we're using weekly candle charts here. So it touched its 40-week moving average, bounced off of those levels. Now, you'll also notice that that orange line on the chart is pointing down. In fact, you will notice that on all the rest of these charts as well. That orange line, which is the 10-period exponential moving average, it's now pointing down on the S&P 500, on the Dow Jones, and on the NASDAQ. Now remember, the rules that surround this particular chart setup don't say you get bearish when that happens. Now you can, and nobody knows the future. Sometimes that will work and sometimes it won't. But typically what we teach to is that we're waiting for the crossover of the moving averages itself. And in the case of something like the Dow Jones, even though that orange line's pointing over, it's going to take several weeks before that orange line crosses below the black line. So remember, as a reminder, we kind of say these things over and over and over again. This particular setup right here is not designed to catch the tops or the bottoms. What it's trying to do is catch the meaty part of that trend along the way. And so the last time we had a crossover, it was a bullish one, and that was back in 2016. And you've benefited handsomely along the way had you got into the markets back then. And so you have to understand that you're also going to give some up off the top whenever that goes bearish as well. And keep in mind, just because things feel hairy right now doesn't guarantee that these are going to cross in the future either. We've had other times in the past, look at the Russell 2000 here, where it sure looked like this orange line was going to come down and cross this black line, but we were bailed out. Same thing happened right back here. So we don't know if this time is different or not. What we do know factually is that this is the second longest bull market in history, and we're only 5% off of the tops right now. So history would suggest that eventually we will have a bear market. These lines will start crossing, and we've got to prepare accordingly. I think of the type of turmoil that we've had in the markets here recently as days where you just sit down and you physically write down what businesses do you want to be the owner of. There's a good chance that we'll have some sort of a bounce back at some point in 2018 that, last week was not the ultimate, chance to get out when markets were reasonably high. We could chop and back and forth for quite a bit here in the next coming months. And if there are situations in your portfolio, if there are investments that you don't think deserve to be there. Remember, we change our mind as investors. You might have thought when you first got in that was the perfect stock for you, and now you've come to learn that indeed it was not. Well, remember that in the future. If you get a bounce back up in the market, maybe that's your opportunity to liquidate that, and ask yourself, what are the soldiers you want behind you as the general when you're going into that next bear market? And I hope they're high quality, robust names. At least that's the way that I try to think of my long-term portfolio. All right, let's take a look here at our next chart setup, and this will be our sectors 12 grid, and this is where I will turn off the camera feed, and so that way you guys can see all 12 of these charts. Notice that all of them are pink across the board. The bottom fell out of this market. That's basically what these charts are telling you right here. We had some areas of the market that were already showing us some difficulties, a few weeks back, and those were the interest rate sensitive areas like your utilities and your real estate. Now, those areas have continued to go down even further. So keep in mind that we had maybe a few signs that the market wasn't all roses. But admittedly, unlike my comment on the Russell 2000, you typically don't turn to the utilities and the real estate sectors and say, yeah, those are the ones that we keep our eye on to determine market direction. So sometimes these things like, these VIX ETFs come out of the blue, and they can't be predicted. Remember, if something could have been predicted, it would have been priced in already into the stock market. That's what makes, market turmoil so interesting and fascinating to me, is that it can't be predicted. It comes out of the blue, and it's something that you don't know, which is going to create this havoc. So you've got to know yourself as an investor, understand how your portfolio is situated at all times, and if you find throughout various market turmoil that you're feeling very nervous, very uncomfortable with whatever it is that you've been doing, then you need to adjust accordingly. Remember, all of us humans are made up differently from one another. All right, so as we take a look at the sectors here, notice across the board, they are pink charts telling us that we do have bearish posture on all 11 sectors of the stock market here right now, to various degrees. Some of them are very bearish, others are just getting a little bit bearish. As we take a look at our next 12 grid, which will be the foreign markets, again, it doesn't matter if you're hanging out here in Boston, or if you're in Beijing, or if you're in Beirut, it doesn't matter. You're seeing equity losses across the board to various degrees. Now, what you will find is that there are some markets that maybe are hanging in there a little bit better than others. One, I guess, that catches my eye on this group of 12 grids is the very first one, Brazil up here, which is kind of interesting all by itself, because typically when you find energy stocks that have been crushed the way that they have here recently, and a resource-rich economy like Brazil is sometimes going to take it on the chin a little bit more than others. We've certainly seen that out of Canada, but Brazil's actually held up there pretty good. And yeah, we do have enough of a pullback to give it a bearish posture. And remember, this little label up here that says intermediate term posture is 73.29 and falling. Remember, when it goes below 80 and is falling, we consider that bearish. But from just a purely price action perspective, it has to be somewhat comforting if you already own EWZ to see it bounce off of that rising 30-day moving average in this particular case and have a very strong response to the market today. Brazil was up 3.82%. So for those of you that are looking for bullish opportunities and you're trying to see, what hasn't completely broken down from a chart perspective out there, maybe Brazil fits that bill. Let's now take a look at our intermarket analysis 12 grid. And this is where we take a look at things that are not stocks. And it's kind of interesting here because we've got TNX, which continues to have a green background chart, which tells us that according to the market forecast intermediate term line, it would be considered bullish right now. Now remember, that's interest rates. That's your 10-year U.S. Treasury yields right there. And that's part of the reason we've had some of this turmoil, especially with the utilities and the real estate companies here recently. But we did get what's known as a bearish cluster. Now, before we get too excited about that, we have to remember we did have a bearish cluster here at the beginning of January as well, and that one did not pan out the way that you would assume that it might. So we'll have to see if this one's going to lead to anything more, but certainly it does feel that with the turmoil in the equity markets here in the last 48 hours, there's maybe less of an interest by the Fed to raise interest rates. Now, I think most people still anticipate interest rates will be higher a year from now than they are today. But, if the market was pricing in, let's say, 4 interest rate hikes prior to this week, maybe the market's now only pricing in 3, as an example. So, if that's the case, then we might see that the yields themselves will pull back just a little bit. Bonds themselves will recover just a little bit. One thing that I did mention on Twitter yesterday is I showed a 1-day, 1-minute candle chart of the TLT and SPY side by side. In fact, let me see if I can go over and find that particular tweet of mine. There it was. And you'll notice how yesterday's price action shook out. Here's the S&P 500 here on the right. Let me kind of zoom in a little bit better there for you. And that S&P 500, it opened the session going higher. You come over here, you take a look at TLT, which is the long bond. Bonds were going lower, and then all of a sudden, the bottom fell out of the S&P 500, and it kind of started capitulating on itself. At the same time, we find TLT was used as a safe haven, and money was flooding into the long bond at the time that money was flooding out of the S&P 500. So I'll be curious to see if we start seeing that relationship a little bit more or not going forward. All right, let's take a look at the remainder of these charts. And I guess the other thing that I should point out is, of course, what's been going on with the VIX. Yesterday was a historic rally in the VIX, 100% gain in one day. I don't think that's ever been seen before. So when you see the VIX down 20% here today approximately, I wouldn't read too much into that. Remember, we're still up big on volatility from a week over week perspective despite today's big pullback. And what does that mean from an options perspective? Well, that means from an options perspective, you've got some juicier credits available to you today than you might have had a week ago. And so speaking of which, let's get into our trade application example here for today. And so I'm just going to go back to a regular kind of a single chart here, and I'm going to pull up SPY. We're going to keep things nice and simple today. I did have someone out there in the Twitter sphere talking about what trades to get started with as an options investor here over the last week. And I was kind of talking about how learning credit spreads makes a lot of sense for a variety of reasons. First of all, they're flexible. So you can, once you understand them, you can understand them really from either a bullish perspective or a bearish perspective. So it allows you to kind of be directional to some degree if you want. They're higher probability, meaning that they do make money off of time decay. They don't lose money on time decay the way that you might find if you're the typical newbie to options trading, where you're buying calls and puts. Usually that's where somebody gets started, unfortunately. You're going to lose money on time decay. Now, you might hit a home run, and so you have to remember there's always pros and cons to every single approach that you take, but one of the downsides is that you do have time working against you, and time is one of the only guarantees in the financial markets. Time will continue. And then, of course, another appealing element of credit spreads is that you indeed do get a chance to define your risk to some degree. So that way, if you're just flat out wrong with whatever trade direction you're picking, you know what your worst case scenario is before you get into the trade. And so what we're going to do here today is known as a bear call spread. I mentioned before, volatility has spiked tremendously over the last week, even in the S&P 500, which is what I've got pulled up here in the form of SPY. And so what that means is if we're selling spreads today, we're probably getting juicier credits, and we can push our break evens further away if we want to, or receive a higher reward on risk here in the near term. And so let's see what's available to us looking at SPY. I'm coming over here to the trade tab, and I'm going to come down here to the March contracts with 38 days until expiration. These are your normal monthly contracts in March. And so as we take a look at this, a lot of times we start with a 30 delta for where we're going to be selling a strike. And so you can see down here we have a 30 delta at 277. And you'll also notice that the implied volatility for these contracts as a whole is up to 27%. Now, it wasn't too long ago, we were in the teens on implied volatility. And so we're getting extremely juicy credits right now by examining this trade at this moment in time. So again, remember, the S&P 500 posture is now bearish. That's why I'm looking at selling a bear call spread. It's a credit spread where you take in money to start that trade. So what I'm going to do is I'm going to focus on one of these contracts. Now, I was actually examining the 278 before I did this video here, before the market closed, and I was able to get a credit that I felt was acceptable. So that brings up that point I was mentioning a moment ago. A lot of times you can be, looking at the 30 delta and getting an acceptable return on risk, but when volatility spikes the way that we've seen in the last 48 hours, you can push your break evens even further away if you choose. Now, if you're really confident in the trade, you might not want to do that because remember, the closer the strike is that you sell, the more profitable it's going to be for you. So everybody's got to kind of make that determination on their own. But in this particular case, let's see what happens if we look at the 28 delta instead of the 30. So what I'm going to do is I'm going to right click here. I'm going to go to sell vertical, and that's going to pull up a $1 wide spread. I'm going to change that to a $2 wide, and you'll notice what I've set up here is I'm selling the 278 call in March, and so this is the one again with 38 days until expiration as of today when I'm doing this video on the 6th. And so we've got 278 as our sold strike and 280 as our bought strike. Now the reason we're buying the 280 is because in case we're flat out wrong, what if the market just surges from here? We have some unexpected good news and markets just rally beyond belief from this moment. That's where that defined risk comes into play. We can afford to take risk if we know what that risk is ahead of time. You're not going to be able to define your risk too well on something like that XIV that I showed you earlier where you're down 90% in one day. Hard to define your risk in a situation like that. This, a little bit easier. And so as we look at this, we say, okay, well, is 49 cents good enough on a $2 wide? One way you can determine that is if you click on the confirm and send, it'll show you what's your max profit and what's your max loss. Now, a lot of times what David and I are shooting for, minimum 30% return on risk. So if I get my calculator out here and I take $49 and I divide by 151, you can see that that's going to be a 32% return on risk. It's not a guarantee that it's going to work, but it is higher than average probability because we have time decay working for us. Now, effectively what we're trying to do with this trade, for those of you that are somewhat new to trading credit spreads, is we're kind of drawing our line in the sand. 278 to some degree is our line in the sand. Technically, we're going to have 49 cents in addition to that because we're taking in a credit on this trade. So some of you might want to think of it in terms of $278.49. Well, if we look at the chart, 278.49 would bring us about somewhere right in here. It's kind of hard to get it exactly, but basically meaning that the market, which we now consider to be bearish according to the market forecast indicator, would have to rally fairly strongly and go up and through this moving average to threaten our trade. So, can it happen? Of course, anything is possible. But judging by how things have shaken out here recently, there's a lot more turmoil. And so we're going to go ahead and place this practice trade to see how a bearish trade can work. Remember, a lot of you might be only comfortable with bullish trades up until this point. So it's important for you to kind of shake the rust off a little bit, practice some of these bearish trades, and that way you're not caught blindsided if we are to indeed go into some sort of a 20% true bear market at some point in the future. So I'm going to go ahead and place this trade, confirm and send that off. All right, so let's go ahead and start winding things down here. Again, really appreciate you guys checking out these videos tonight. I know these are tough times. There's no denying that. We're all feeling a little uneasy here with the way things have been going here with our portfolios, myself included. But remember to try to keep a clear head in what you're doing. Don't panic at the worst possible moments there. Remember, some of those leverage products can be very dangerous. For those of you that are new, try to stay away from them. Sometimes I know it's like a bug to the zapper in a hot summer night, and you're just too attracted to whatever that shiny new object is, and it does come with disastrous consequences like we did see with XIV. So be very, very careful with those leveraged instruments that are out there. And mostly, hope you guys are hanging in there okay, and we look forward to continuing to serve you here during these market outlook videos going forward. So you'll have David with you tomorrow, and I'll be back on board with you on Thursday. Until then, best of luck with your trades and your investments. Have a great night.